Hey everybody, Chad Frantzen with Wealthbuilders Investments and the Kingdom Finance Show. Hey, thanks for joining us today. And I thought in light of everything going on in the markets, we're sitting here on April 24th, 2025, recording this. That's important because as volatile as the news cycle is in the U.S., things can change from day to day and even hour by hour. So excited on today's show. I want to talk about tariffs and the stock market and what's going on in the capital markets world and the economy. And I thought, what better person for me to have join than a good friend and a strategic partner, Matt Monson, who's a partner and portfolio manager with Sovereigns Capital. And many of the families that we work with at Wealthbuilders Investments have Sovereigns and Matt's team inside their portfolio. So I thought, hey, let's get together with Matt. And Matt, you and I were talking offline here last week just about the markets and tariffs. And I said, hey, let's jump on a video call and record this just for our network of friends and clients. So Matt, welcome to the show. Thanks for being here.
Yeah, great to be with Chad. Thanks for the invite.
Yeah, so we've seen quite a historic first quarter to 2025. And what are you guys talking about at Sovereigns Capital when you look at the markets and you know what Trump is doing with tariffs, and how do you guys see the world after the first quarter and everything that's happened in April?
Yeah, thanks for the question. I tell you, I mean, things change a lot. It can be a Friday night at 6 p.m. And if you walk away from your computer, things can change on Saturday morning and then Saturday afternoon and then Sunday afternoon again. And then Monday morning, there's even new news. So, I mean, it is dynamic to say the least. And first quarter, not even first quarter, but through last night, through April 23rd, you know, we've seen our fund, for instance, down 8.7% year to date, which thankfully is better than the market at being down 10.7% year to date so far. So it's been a big sell-off so far, but there's been a lot of changes day to day and week to week inside that. And so it's certainly been a roller coaster.
Yeah. Yeah, I mean, we work with a lot of what I call retail investors. We have retail investors and then what I call institutional investors. And, they have all these stats and studies of historically the retail consumer investor, the mom and pop, our families, they're going to get so wrapped up in greed and fear with what they see on the news or what they see on social media. They're going to call their advisor or their portfolio manager. They're going to go into Fidelity or Schwab if they're self-managing, and they're just going to hit the sell button.
Yep.
And it's unfortunate because if you stay in the market and you understand what you own, whether it's equities, fixed income, commodities, whatever, if you understand what you own, then you have a better likelihood of staying the course. So I'd love to get maybe some perspective from you guys on the research you're doing, and just to help clients who are listening, how do we understand the dynamics of what the market's doing? Again, it can be so volatile. Like the other day, there was a rumor about some tariff thing on social media, and the market was up 4%, and then it ends up being down 1% because the rumor ends up not being true. But that's a lot of noise. So what advice would you give investors when you think about how to have wisdom during these volatile times?
Yeah. Well, just digging into the data over the last 26 years, since going back to 99, there's only been 8 market sell-offs that have sold off more than 20% from peak to trough. Now, 20% is a good number because it's the definition behind what a bear market is a sell-off of 20% or more from peak to trough. And so with only 8 sell-offs over the last 26 years, these are historic times. Now, the average sell-off in those 8 was down 30%. Now, we've only reached 19% down if we look at our peak, which took place in February, through our trough, which took place a week ago. And so we're only down 19%. Now, if the average big sell-off is 30%, does that mean that there could be more? Absolutely. Now, what we see as interesting is that coming out of these sell-offs, out of these 8 bear markets, on average, the stock market is up by 53% over the first 18 months. And so it's really benefited those who put capital to work in the bottom of the trough to benefit from that stock market recovery. Now, Jed, you said one of my favorite lines is that I think Buffett has been attributed as saying this, that to be greedy when people are fearful and to be fearful when people are greedy. And so right now, I think that fear is prevailing in the market, and that those who deploy capital, as long as they don't need it for the next 12 plus months, I think will be rewarded.
Yeah, that's so true. And your stat, just repeat that again, coming out of a bear market historically, 18 months after the trough of a bear market, equities have been up 50%. Was that the number?
Yeah, 53%. And that's from the trough. And so we may have already reached the trough. The trough may be coming. No one knows, but those are the stats.
Yeah. And you guys maybe share a little bit. I want to stay on the kind of the current market, but talk a little bit about your philosophy at Sovereign's Capital and the Flourish Fund, which we really appreciate, of how you look at companies, and why you select companies for your portfolio, and then we can kind of dive into the analytics for tariffs. But maybe just start at a high level of what do you guys look at when you're looking for companies? Because I know you invest in small cap, mid cap, large cap, all different size companies. Maybe share a little bit about your investing thesis.
Yeah, for sure. I would say within faith-driven investing, the space is dominated by negative screening. And what we do that's quite different from that approach is, rather than avoiding the bottom 10% of companies that most conflict with biblical values, what we do is we turn that upside down and we look for the top 2% of companies that best demonstrate biblical values. So we have a framework where we only invest in public companies led by faith-driven CEOs who are then demonstrating through action, building a culture that enables their employees to flourish. So our key thesis here is that if a company creates an incredible culture, it can attract and retain some of the highest quality talent in the marketplace. And that if a company has some of the highest quality talent in the marketplace, it should be able to generate financial performance that's better than that of its peers. And it's because we see it in the data that when the culture is great, the employee retention rate skyrockets. And when that happens, oftentimes financial performance follows. So just to wrap that up, we don't just look for faith-driven CEOs. We're really looking for visible markers inside the companies, such as HR benefits that are ahead of the industry, chaplaincy benefits, servant leadership orientation to what the company is doing, Bible studies and prayer groups, because everyone needs a friend walking into work, and what better way to do that? So there's a number of things that CEOs can do to build these exceptional cultures, and those are the types of things that we're looking for.
I know some of the research that you all have done, even comparing it to the market, you're able to invest in companies that have, stronger return on equity to shareholders over the long term, and even a more attractive PE, which we need to explain what the PE ratio is here. But maybe let's talk about that a little more and how you look at those companies.
Yeah. So the PE ratio stands for price to earnings. And so taking a quick look at that, if the EPS, or the earnings per share, is $1 and the share price is $16, that means that the PE ratio is 16, which means that your share price is paying for 16 years worth of earnings if earnings don't grow. And if earnings grow, it ends up being less than 16 years. So just to give you some data around what this looks like in comparison to the market, our Flourish Fund ETF, ticker SOVF, has a forward price to earnings multiple of, looking it up, 16 times. That compares to the S&P 500 at 21 times, and the Magnificent Seven, which are these large 7 technology stocks, Amazon, Google, Microsoft, so on and so forth, trade about 27 times. And so as you're comparing what we do to the market, you're paying a fraction of the price to earnings multiple, or the valuation, to own our ETF as you are the market. So one would naturally assume that the earnings growth rate in our portfolio would be significantly lower than that of the market if the PE multiple is lower than that of the market. And actually, when you unpack that, you find out that it's our earnings growth rate is expected to be higher than that of the market. So the earnings growth rate in SOVF is 13.3%, the S&P 500 is 12%, the Magnificent Seven is 13.8%. So you'd expect for SOVF to be at such a steep discount to the market and to the Magnificent Seven, whereas in reality it's ahead of that of the market and on par with that of the Magnificent Seven. And so that's something that we feel really strong about going into all this volatility, is that we think we just own great companies with a lot of growth for a really low price.
So to summarize, then, really you can be investing at a more value position. Let's say you can invest for the similar growth to the broad market and even some of these tech companies at a lower valuation. Let's say you're not going to pay as much for that as it relates to this PE ratio. Would that be accurate?
That's right.
Okay. Well, that's great. I mean, a lot of the feedback we get from clients is, well, the market, hasn't had a big sell-off in so long, and real estate is really high, gold is high. The market prior to this correction was, can it keep going? And I think that's a key takeaway when you talk about how do we invest money wisely with good stewardship of, hey, how much do we want to overpay? Sometimes it pays to overpay, but sometimes it makes sense to really look at the numbers of earnings growth and what the values are. So there are still companies out there that are not, egregiously overpriced. I mean, 16 times is the PE ratio that you mentioned for your portfolio, and that historical average is right around there if you look at the market, right?
Yeah, the S&P 500 averaged 16 times in a period of time before COVID. During COVID, that 16 times became extremely elevated, and it has remained elevated since then. As I mentioned, the S&P 500 today, even after the sell-off, is trading at 21 times. And so 21 times is significantly ahead of the 16 times average. And so when we think about our portfolio trading at 16 times, we're not ahead of the historical average at all. And kind of a more nerdy data point within there, typically these really high growth, small and mid-sized companies trade at a significant premium to that of the market. So going back, if the S&P 500 is at 21 times, you'd expect these companies to be trading north of 21 times. And in this market to be quite a bit below that at 16 times, we find it just be exceptionally attractive.
Yeah. That's great, Matt. Well, let's dive into a little more of, if you don't mind sharing, just some of the research you and your team are doing, looking at companies out there. Obviously, there's depending on the tariff policies and where companies, if they're U.S. based or international based, and where they have sales, right? How much exposure they have to China or certain other countries that are, more exposed to tariffs. How do you all look at even your own portfolio after you've screened them, as we've talked about, of the risk of tariffs in your portfolio, just to give us an example?
Yeah. And so we're active managers at Sovereign's Capital, which gives us the benefit of being able to do deep research on each one of our companies and avoid what appears to be a landmine that may be coming down the road. And so right now, with the state of where tariffs are, we believe China is the big point of focus for us. And as you broke down, within Chinese exposure, we think about it in two different layers. And so I'll just unpack all this over the next minute or so. First of all, when we have companies that sell goods into China, we think that's the greatest level of risk. And so I'll explain why that is. It was only a few days ago that the Chinese government asked Chinese airlines to stop buying Boeing airplanes. And so if you're a large U.S. company like a Boeing that sells a lot of your goods into China, and at any moment those sales could disappear. That's a really big issue and a big risk for US companies. And so as we went through our portfolio and looked at the companies that were most exposed, we found one company that had 29% of their sales into China, another one with 46%. And so it was only 2 of the 80 holdings that we had in the fund, but we weren't willing to take that risk in case the next day's headline was that China was asking their companies to stop buying from these 2 large US companies. And so those were easy for us to be able to exit from the portfolio and to replace with companies that didn't have that level of risk. I would say on the other side of the risk, Chad, which is something we think about more with tariffs, is that when companies are manufacturing, and let me just go back for 1 second. Tariffs are both ways, right? Tariffs are over 100% on sales into China and in products that we are importing out of China back into the US. So even if the Chinese government didn't say, stop buying these goods from these 2 large US companies, the 100% plus tariff is going to make those products unattractive to Chinese consumers and potentially more vulnerable to replacements of native Chinese company goods that can replace them. Okay. So pivoting now back to the manufacturing side. When we have a US company that's manufacturing, let's hypothetically say 1/3 of their goods in China, if that same US company has, let's say, 1/3 of their sales to Germany, they're going to manufacture that good in China and they're going to import it into Germany to be sold there, and they're going to dodge those tariffs. So where we find the most risk is when a U.S. company has all of its sales to U.S. consumers, but it's manufacturing a substantial amount of their goods in China. And so those goods are going to face that import coming back to the U.S., that import tariff, and it's going to become less attractive to consumers. If a company is able to pass on price, it's just a lot of additional price that the consumer has to face. And so in those cases, consumers may pivot and they may buy something that's made in the United States or made by another country, such as Vietnam, which may end up facing a lower import tariff. So I just put a lot out there on the table, but those are some of the things that we look at and the risks that we assess for each one of the 80 companies that we hold.
Mm-hmm. In your research, have you seen, are there particular industries or sectors in the U.S. economy that because of we mentioned Boeing as an example. I know Qualcomm is one I've read about quite a bit that has they make a significant sales in China. Are there other, this trickles down not just to public companies, but even people that are listening that are small business owners, right? That own retail stores and they get their goods. Are there any particular sectors that really stand out to you all in what you're seeing that have more exposure than others?
Yes, absolutely. Consumer electronics, apparel, those being 2 of the biggest ones. And so those were where we went first inside our portfolio to look at where our goods were being manufactured. And in some cases, there's long-term agreements and a company might be manufacturing 100% of their goods in China, which would be a problem. In other cases, we found we have one company that does apparel, and almost all of that is coming out of Vietnam. And so we were pleased to find that. But, people don't know the answers to all these questions until an issue like this arises. And then now you've got 80 companies on your research list where you got to figure out where all their goods are coming out of.
Yeah. Well, and there's a lot of analysts like you on Wall Street and off Wall Street that are obviously crunching the numbers on this. And where are you seeing, assets pivoting to? Obviously we've seen a huge flight into gold as people have gotten out of a lot of these higher expense ratio, lower earnings stocks. Any other places you're seeing money rotate into?
Yeah, historically, the flight to quality has always been into US dollar and US Treasury. That has been true for decades, right up until now. And there's not been a good replacement for that. There's no one destination where you're seeing that capital moving to. It's not as if Swiss francs has received it all, or Bitcoin or gold. I would say all of those markets, Bitcoin, gold, Swiss francs, are all so much smaller than the US dollar that if ever there's a moment that the US dollar has outflows and it goes to one of those three safe havens, it can move all of those prices materially because those markets are all so much smaller than US dollars.
Mhm.
But there hasn't been a key asset class yet that has stepped up and taken the place of the US dollar as a safe haven in a risk-off environment like this.
Mm-hmm. Mm-hmm. Yeah. Mm. Let's talk about Matt. Outside, kind of putting tariffs to the side in light of just where we are in the economy and with the current administration. Obviously, there's a lot of pro-business deregulation goals that I know the administration has that probably will be coming after they get a lot of the tariff stuff figured out. I expect to see, personally, I expect to see the tax cuts come back. I expect to see hopefully the depreciation benefits coming back on real estate and equipment. But let's talk about, are there other areas of the economy that you all are concerned about, that you're more cautious about, just in light of the macro environment right now?
Mm-hmm. Yeah, we saw a bit of a decelerating before Liberation Day, as Trump called it, when tariffs were announced. And so we were already angling to be a little bit more cautious. So there's one thing that we often talk about with our companies is what percentage of their revenue is recurring revenue. And so the term a lot of folks throw around. But if a company has a long-term contract in place and they get paid on the ongoing headcount of their customer, all their customer has to do is not fire their employees. And our company, our vendor that might be selling software into a customer, for instance, still gets paid based on their headcount. There are other companies in the marketplace that only get paid on growth. And what I mean by that is you might be a hiring firm that's doing staffing. And so if your customer is hiring and asking you to go out and fill those positions for them, you get paid. If your customer stops hiring, then all of a sudden your revenue dries up. And so on the margin, there's been a couple firms that we really were excited about. But as the economy has been decelerating and as growth in the economy could decelerate, we think that their revenues are more at risk. So on the margin, we've moved out of companies that have less recurring revenue into companies with more recurring revenue over the last month.
And what are some examples when we talk about recurring revenue business models in, let's say, in the U.S. economy? What types of businesses, what type of industries do we see a lot of that have more of that recurring revenue?
Yeah, that's a great question. I can give you a few different examples. So, one company that we own develops the app and the whole back-end banking system for credit unions. Think about a credit union. It's a brick and mortar, it's on the corner of First and Main, but they're traditionally not, technology businesses that have a really great app or website interface. So when you develop that app or website interface for that credit union and you get paid on the number of customers the credit union has, so long as people aren't walking in the front door of the credit union saying, I want to close down my account, our company is going to get paid the same amount of revenue next year as it was last year. And so that is a great example of a recurring revenue business. Using the flip side of that, there's a landscape supply business in the marketplace. And what they do is about 50% of their sales go to new build landscaping projects and 50% of their sales go to replacement. So I'll explain that for just a brief moment. If you've got a sprinkler system in your front yard and one of your sprinkler heads breaks, the chance has it that you pay $100 to have a guy come out and replace the sprinkler head is really high. However, if you and your wife have been talking about paying a few $1,000s to re-landscape the front yard, you're unlikely to do that in a recession, and you're probably going to wait until the economy finds its footing and before you spend thousands of dollars to tear out all the shrubs and replace them. So when we see a landscape supply company like that does a lot of new build work, and whether it's a new building that goes up or you're doing a whole kind of replacement in for your front yard, we think that those revenues are more at risk and not the kind of investments that you want to have if the economy is on, uneven footing and the risk of a recession is inching up.
Yeah. Yeah. And so the more of those type of companies you have in your retirement account, your IRA, 401k that you're investing in, the more volatile, a little more higher risk we're talking about. Again, we're not here to give specific investment advice. We're just talking conceptually. But if you have these companies that have more non-recurring revenue, more sales in China, companies that have a higher price to earnings ratio, just to kind of capture some of the things we've talked about, you've got a higher risk. We would have different terms for it in our industry of how we would measure that, right? But it would be a higher beta, right? It have a higher potential for it could crush it and do really well. But in this environment, when there's a lot of downside selling pressure, it could be down more than companies that have recurring revenue, more modest PEs, less exposure to sales manufacturing in China.
That is absolutely that's absolutely how we're thinking about it. Yeah. And over the long term, U.S. public equities generate really high returns for investors, and it is volatile on the way. And so there's, a time and a place to be a little bit more risk off. And this is, I think, a good time and a place to be in investments that we feel like will hold up better should a recession come our way.
Yeah. And that's one of the things we've been doing at Wealthbuilders Investments is, for a lot of our clients, we have them in 6, 7, 8 different asset classes, in Solomon, outside of Jesus, the wisest person in the Bible, richest. He said in Ecclesiastes 11, you should give or invest in 7 or 8 different ventures, for not what will come upon the land. And it's funny how Wall Street and academia, Matt, have proved that that's correct through all their Nobel Prize and all the research they've done. But I love this concept of just dollar cost averaging. And, Matt's an extremely intelligent analyst, and Sovereigns is a great company. And I think we've got good talent here, but no one knows, right? I mean, even the talking heads on CNBC, let's be honest, they don't know when the market's going to turn or when it's going to bottom. But if we just take the emotion out of it, and I hope this has been helpful just for listeners to understand, hey, if you understand what types of companies are in your IRA or in your brokerage account, hopefully it gives you more fortitude just to stay the course. And even consider, and it depends on each person's situation, right, Matt? But this could be a very good time to draw on one of your points earlier of even, averaging, we call it dollar cost averaging, but just putting a little bit money in, monthly or periodically. Any money you put into an investment, you need to have a longer term, perspective on it. But this should not be money. If you've got money in the stock market or in crypto, our opinion is you shouldn't be trying to get in and out of it. You may make some big profits one day, but you might you might lose all of it the next day on it. So Matt, what are your team and Sovereigns Capital, how do you view the economy and the markets just kind of looking out here over the next 6 to 12 months? I know there's a lot of things the Trump administration wants to do on the economy, which I referenced earlier, just with, tax cuts and deregulation. There's some pretty positive things, I think, if we get on the other side of this. I mean, tariffs kind of the big 4-letter word right now, but let's think a little past that of, hey, we get some of these things negotiated. And I think Trump knows what he's doing. He's going to start up here and he wants to get here. And that's just what a great negotiator does. And he's a businessman. He's not a career politician. So he knows how to work the buttons there. What do you guys see outside of tariffs? What do you get excited about? What do you feel will have some potential in the economy once we get past some of these negotiations?
Yeah, we think tariffs are the big risk, as you mentioned, but we were already seeing a little bit of decelerating before tariffs came about. And we think that even if you were to say, hey, let's let's back off the tariffs and let's just go back to where we were before a month ago. We think there's been some damage done around trust with key trading partners that can't be undone, and a little bit of stability that comes from that. I think those are all the negatives, right? That's offset on the other side by the fact that we have the Fed funds rate, interest rates could go down. We have deregulation coming. We have tax cuts. We have investments from other countries and other companies outside the United States that are coming to the United States, driving growth. And so I think there's a lot to be excited about. And we think that, long term, I think a lot of the trade rebalancing is a genius play. And I think that it's unfortunate that in the short and medium term, it can be painful while that trade rebalancing takes place.
Yeah, no, that's true. And there is a lot of talk, on the interest rates and kind of where that's, I do think Trump obviously stated he wants to see that rate come down. And I think that will help, right? Particularly in the real estate, we have a lot of families that we work with that are very active in investment real estate, right? Either directly or indirectly on that. So certainly watching what the 10-year bond, that's one of the things we watch. So if you're keeping score at home, you want to track what that 10-year treasury bond is doing. I think it's been around 4.3%. This is probably for another conversation, but I'd ideally love to see that around 4%. I think if we could get that down around 4.0, that would help out a lot just on flow of money, right? And mortgage rates and some of the other velocity in the economy. Well, Matt, this has been great. Any closing thoughts you want to share on what you guys are seeing in the economy, or any questions you want to throw out there?
I've just circled back to something you said up front, that when other people are being fearful, putting a little bit of money to work, so long as you're not going to need it in the next year or two, and you can be a long-term investor, I think you can be rewarded. And so buying the stock market when it's taken a dip and tracking it on the way up has rewarded most folks over time, as we've seen. And so we are just, we're working hard with our heads down, evaluating all the risk across all of our companies. And we're just trying to be unemotional about how we are investing capital and buying the companies that look the most attractive.
Yeah. Well, I think that's a good place to land on that. You do have to take the emotion out of it for sure. And you make your money when you buy, right? Whether you're buying, doesn't matter. Whatever you're investing in, you buy, you do make your money when you buy. So I'm always fascinated by people I meet that are more interested to talk to our wealth management firm as a prospective client when asset classes are at all-time highs than right now. If you really believe in the capital markets and long-term investing, this is like going to the mall or going to Shields or something, and everything's, some things are 20-30% off that you like anyway. So, well, this is great. Again, Matt Monson with Sovereign's Capital. He's a portfolio manager and partner there. And they're one of our key trusted allies at Wealthbuilders Investments. And so if you want to learn more about putting together a comprehensive portfolio, applying some of the concepts that Matt and I have talked about today, we'd love to connect with you. If you're already a client, we want to thank you for working with us, and we'll be happy to visit with you more on what we're doing inside of the portfolios. Best way to connect, if you want to learn more, is go to wealthbuilders.net/invest. That's wealthbuilders.net/invest. And we'll put a link down in the show notes for that. And Matt, we'll have to have you back, and maybe even some of your other colleagues at Sovereigns. I always enjoy hearing what you guys are thinking. I do believe the work your company's doing is first class and on the cutting edge of just how do we apply faith-driven values? How do we apply our worldview to economics and to capital markets and investing? And so I think that's a great combination. So Matt, thank you for being here, and we'll see you guys next time on the Kingdom Finance Show.
Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a Kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show. The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Authentic Counsel, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine risk factors and other information contained in the memorandum.